Today, I'll talk about how small businesses, medium-sized companies, and even Fortune 500 corporations use whole life insurance. So we've got the company and then also the executive in most cases. So everything that you'll see in blue is related to the company, and everything in black will be related to the executive. So depending on the size of the company, you'll see these plans established for one or multiple executives. Let's assume we're dealing with a small business who's taking one life insurance policy out on a very valuable employee named Joe. So Joe is going to be the insured, meaning the life insurance policy is on Joe's life, and when he dies, that life insurance benefit is paid out. Now, Joe does not own the policy. The owner is the company. So how does this work? Well, the owner of the policy gets to pay the premium. So the contributions are made by the company. So they're going to pay the premium, and this could be a lump sum payment, or it could be a plan where they pay into it for 5 to 10 years. And some companies will set it up where they fund the policy until the insured is age 65 or something like that. But the company is the entity responsible for making the contributions. Now, with a whole life insurance policy, that is going to build what is called cash value. Who gets the cash value? The policy owner. So as those contributions are made, they will build cash value. That'll earn a return, and the cash value can be accessed anytime by the company as it's very liquid. And as long as we follow IRS rules, it can also be accessed tax-free. And then lastly, you also have the death benefit of the policy, which is the monetary benefit that is paid out upon the insured's death. So they make the contribution, that builds cash value, and they'll have more in cash value than what they paid. And the death benefit will be significantly larger than what they paid into the policy. For example, they might pay $10,000 per year for 10 years and start with a death benefit of $300,000 or maybe even $500,000. And the cash value will earn a return as the years pass as well. So the benefit is for who right now? Meaning, how would you feel if you were Joe? Tell you how I might feel. I might say, hey guys, you're taking this life insurance policy out on me, and yeah, you're putting money in, but you get this cash value benefit. And if I die, you really cash in. You trying to kill me off or something here? What's going on? Well, no, they're not going to try to kill Joe off because they're taking this policy out on him because he's very valuable to them. He's worth more alive than he is dead. So what you'll see in these plans is a benefit for Joe, and it usually works like this. The company will say to Joe, Joe, you've got this vesting period. And what it means is if you stay with the company, say for 10 years, sometimes it's a certain age, maybe it's age 60 or age 65. The company controls this and they set everything up front. If you stay with the company for the vesting period, you are going to receive a retirement benefit, meaning we're going to give you money. This is also referred to as deferred compensation. Now, if Joe leaves, meaning he says, I don't care how much money you give me, I'm out. No money, which makes him feel like this. So what this does is create a program that locks Joe in, where he feels, I've got to stay with the company because if I do, I'm going to be rewarded. And here's exactly how he's rewarded. If he stays with the company, meaning the vesting requirements are met, here's what he gets. The company is going to pay him a benefit. And this could be a lump sum of money. Maybe it's $1 million. It's all relative to how big the company is and how much they're funding this plan with. Or maybe it's a situation where they say, hey, the benefit is going to work more like a pension, where we're going to pay you $50,000 per year for the next 20 years. A total of $1 million, but it's spread out. So for Joe to get this, he needs to meet those vesting requirements. That's the benefit to him. Making sense? Okay, cool. Now, what else? For the company, what's the end game here? Well, not the end game, but all the way through, they've got that cash value. And remember, the cash value in a life insurance policy can be used anytime. So what that means is on day one, once they make a contribution, that's going to have cash value in the policy. And because the company owns that policy, the cash value is considered to be an asset on their balance sheet, which is nice. Now, when they pay that retirement benefit out, so they do need to compensate Joe, when he retires, do they want to use money from their revenue to compensate him? No, because he's no longer generating revenue for them. So what they can do is use this asset they've built up, the cash value. So to pay him, call it that $1 million lump sum, they can take a withdrawal or a loan, could even be a combination of both, from the life insurance policy to compensate Joe. So now Joe gets his money, but here's the key on this. Here's the piece where everybody's like, I had no clue this is what corporations do. There's still going to be a life insurance benefit in place, meaning when they take the cash value out, they're not just canceling the policy. It doesn't work like that. So we always want to leave enough money in the policy so we have a sizable death benefit, because when Joe eventually kicks the bucket, let's say he gets his money, he lives a long time and dies at age 85 or something like that, that life insurance benefit is paid out 100% income tax-free to whoever the beneficiary is. Who's the beneficiary? The beneficiary is the company, so they own it. They're also listing themselves as the beneficiary right out of the gates, which also provides key man insurance. So now, when Joe passes, they recover that money that they paid him, and because it's tax-free, gives them some more buying power, which is really nice. So this is often how corporations use cash value life insurance. One very common question that comes up a lot is, hey, what happens if Joe leaves the company when he's alive and we've got this policy with all this cash value on him? Do we just keep it on him, and when he eventually dies, we cash in on his death? The answer is yes, you could do that, but most do not do that. If Joe leaves, what they do is often transfer the policy to whoever Joe's replacement is. So maybe it's Josephine who comes in, but they transfer that life insurance policy. This is not a 1035 exchange. This is referred to as a transfer of insured. You'll see a lot of professional sports teams exercise this provision. When they trade players or executives, they have these old season policies that are compounding at a fast rate. They don't want to just start all over and go through the new expenses again. They'll transfer a 10, 20, or 25-year-old policy to the new insured, and that keeps the policy moving, which is very attractive in that respect. So that's very common to see as well with corporations when they do have a situation where their executives or executive leaves. So that is a high-level overview of how corporations use cash value life insurance. Hope you enjoyed this video. If you did, let me know in the comments below. And as always, I hope this helps.